Hello, traders, and welcome back to another Zoo Tour episode with the Wall Street Petting Zoo. This is our occasional educational segment in which we teach you important skills for trading and investing. Today, we're going to talk about how to determine a fair valuation of a stock, how to determine whether a stock is fairly valued, undervalued, or overvalued. We're going to look at CVS as our example stock today because that's one of the ones that I am watching fairly closely. We're going to start with Fidelity. Fidelity.com has all sorts of research tools that you can use to investigate a stock. You go to Fidelity, you log into your account, and then you come up to this search box and you type in your ticker. In this case, it would be CVS, and it will bring you to this snapshot page that has all sorts of great tools from Fidelity analysts. The first thing that we're going to look at is the PE ratio. This is the price to earnings ratio. What is the price that you are paying for each cent of earnings? With CVS, we have a PE ratio of 21. The market average is somewhere between 15 and 20, but PE does not easily translate into an understanding of whether a stock is overvalued or undervalued. If a stock's earnings are declining over time, it will tend to have a PE below 15. If a stock is growing somewhere between 2 to 5% in terms of its earnings, it will tend to fall in that 15 to 20 PE range. And then if a stock's earnings are growing faster than about 5%, you may see a PE that's above 20. So the opportunities in the market are going to be stocks that have a PE below 15, but that are starting to see real momentum in their earnings and they're starting to grow their earnings. Those are going to be stocks that are undervalued. Stocks that might be overvalued are stocks that are growing their earnings less than 5% per year, but have a PE above 20. So watch out for stocks that have a PE above 20 if they aren't growing faster than about 5% per year, and get real excited about stocks that are growing their earnings more than 5% or even in the 5% range that have PEs somewhere below 20. All right? Now, a couple other cool things to look at on the Fidelity page. There's, of course, the analyst rating, 8.8 out of 10. So analysts are fairly bullish on CVS. That tells you that analysts are pretty excited about this stock. They think it's a good buy. We can look at the EPS growth trailing 12 months versus the prior 12 months. So that means in the last 12 months versus the previous 12 months, CVS's earnings have grown by 11%. So that 21 PE ratio is justified on CVS. Its earnings are growing pretty nicely, but we did see in the last quarter versus the same quarter prior year, we actually had a decline in earnings. So you got to watch out because the year-long earnings picture may not reflect sort of the latest data. This gives us the latest data, and that looks a lot less bullish for CVS. And then if we scroll down here to the bottom, we get this fundamental analysis category from S&P Global Market Intelligence. Somebody else at this analyst firm has looked at the PE on CVS. They've done the math and determined that CVS is on a scale from 0 to 100, with 0 to being overvalued and 100 being undervalued. They rate CVS a 92, so that's an extremely good valuation on CVS from this analyst firm. Now, you got to be aware that this is just one analyst's opinion, and other analysts will evaluate the value of a stock differently. And so, for example, Yahoo Finance tends to be very conservative with its valuations. So if we click over here to Yahoo Finance, you would type in their search box, it's finance.yahoo.com. You would type in their search box CVS, and then you would search for CVS, and that would pull up the page for CVS. Unfortunately, it's trying to show me an ad, which is very annoying. And then if I scroll down on this page for CVS, right down here, I will see this fair value rating. And Yahoo Finance rates CVS near fair value. So very rarely do I see something that's down here in the green on Yahoo Finance. Usually they rate things either near fair valued or overvalued because they're a lot more conservative in their estimates of valuation of stocks than the S&P Global Market Intelligence is. So looking at the two together can give you some idea of whether a stock might be a fair value or not. Another tool that you can use is TipRanks.com. Come here, you type in the search box the ticker that you want, CVS, and it will pull up this summary page that gives you the summary analyst price target for the stock. This is what analysts think CVS is worth. This is the average price target from analysts. You can see that the analyst price target of 81 is significantly above CVS's current price of 72.47. So there's 12.5% upside according to the analyst. That's a really nice valuation on the stock. It suggests that CVS has room to run. Now, I will say that stocks tend to be below their analyst price targets. Analyst price targets tend to be fairly optimistic. So it may not necessarily, CVS may not actually hit this price target, but that's what analysts think it's worth. So we do have, a pretty nice valuation on this stock. You can also look down here and see over time what have the analysts thought about the stock. You can see that until recently, their view on the stock was actually declining, hit a low about June. And then in more recent history, the analyst view on the stock has actually been improving. So we've got momentum in terms of what the analysts are thinking on the stock. So we may even see this price target increase over the next few months if this upward trend in analyst opinions continues. So not only do we have a valuation, a price target that's significantly above the current price, but we also have the potential for this to increase. And typically the momentum will continue at least for a little while before it tops out. So we've still potentially got room to move on CVS here in terms of the price target. All right, so that's how you look at what the analysts think about the valuation of a stock. Now let's look at how to do sort of your own analysis. And for this, I'm going to use Zacks.com. You'd go to Zacks.com. You would type in the ticker that you want in this search box. So we'd type CVS. And then you would come down in the menus on the side and you would go to the price and consensus chart. It would pull up this page and then you scroll down to the price and consensus chart. It might take a moment to load. It's a little slow loading on this site. This black line here is the price of CVS. And over here on the right side, you can see the prices. So right now, CVS is right about 72. So that black line is right there. And then we have these different colored lines with a legend up here at the top. So you can see, and those correspond with this left-hand key right here. And this is the analyst consensus estimate of what the stock is going to report as its earnings for the year. Okay, so in early 2016, analysts were predicting that CVS would report a little bit over $6.50 per share in 2017, the next year. And you can see that over time, that analyst estimate actually significantly dropped. Analysts decided, okay, maybe CVS will only report about $5.20 or $5.50 on its earnings report. Okay, we do see, and we want to see this, that each year the analyst estimate is higher than the previous year. That tells us that analysts do expect the stock to grow its earnings over time, which is really important. You don't want to buy a stock where the brown line is below some of the other lines, because that indicates that analysts actually expect the earnings to decline over time. You only want to buy stocks that show this staircase where the most recent or the furthest lines out are higher than all the other ones, because that indicates a growing company. The other thing that you want to look at is what's the momentum. So if the line is upward sloping, as it was for most of 2018, that suggests that analysts are increasing their outlook on the stock. So analyst ratings are getting better. That company is improving its execution, maybe cutting its costs. That would change the momentum in the stock price. Here we saw a period where analyst estimates were actually declining. So analysts were getting less bullish on the stock's earnings. They were revising their outlook or their forecast for the company downward, and so that will actually move the stock downward. All right. if in periods where we have an upward sloping line like this, very often the stock price will come up to the top line and meet the top line. In CVS, it never got there. It didn't have enough time to get there. But often, this blue line is sort of the fair value of the stock when it's got an upward slope. When the slope goes downward, you will typically see this black line go either meet the lower line, this lowest blue line, or even come below that lowest blue line. CVS got quite a bit below that lowest blue line. Now that we see the momentum upturning, we see the slope in this line turning back upward, we could potentially see CVS come all the way up to meet this brown line right here. Especially if analysts were to suddenly turn a lot more bullish, this line got a lot steeper in its upward direction, we could see the black line come up to meet the brown line. So when you are looking at this chart, a stock that is way below the lowest line, that is starting to see momentum turning upward, is one that has a lot of potential. We could see this stock come up to meet this brown line as the slope of these lines all turn upward. If you see a stock where the black line is way above the brown line and the momentum of these lines, the slope is starting to turn downward, that's a sign that that stock could take a major plunge and come down to meet the lowest line rather than be sitting up above the highest one. A lot of the mega cap companies like Amazon and Netflix will tend to hang out way above this brown line. Especially tech companies that people get very excited about tend to hang out way above the brown line, so people are willing to pay a lot of money for the promise of future earnings. Whereas stocks like CVS that are more sort of traditional retail stocks sometimes will hang out a lot below the lines, not be quite as strong. But I think because CVS has an aggressive growth plan, because it's generating a lot of hype right now, we really could see it come up to meet this brown line. And especially with the slope of these lines turning upward. If analysts continue to revise their estimates of CVS's earnings upward, we really could see this come up to meet the brown line. So this is another way to sort of do your own analysis of where a stock price is situated in relation to expectations of its earnings and whether the outlook for the stock is up or down. Basically, I typically don't buy stocks if they are at this brown line or higher. I only buy stocks that are well below the blue line, but that show a lot of potential for growth and that seem to be uptrending. So that's how I do my analysis of which stocks are fairly valued. If you appreciated this video, guys, please give us a like, share, or comment on YouTube. Check out our Facebook page. You can find the Facebook link below the video. You can also follow us on Twitter. And we've got a referral link for Webull so that you can sign up for a Webull account, put $100 in your account, and we get a free stock, you get a free stock. It helps us support the podcast. So if you could do that, that helps us out a lot. Thanks so much for watching, guys. If you're interested, please check out our news show. We've got a news podcast that we post not only on YouTube, but also on Apple Podcasts and Podbean if you're on Android. So you can check that out. And we've got a whole playlist of other educational videos that you can find on our YouTube channel, Wall Street Petting Zoo. Catch you next week for our next zoo tour.